Hey, you've got Kevin here. I'm one of the founders and CEO of Station A, but I'm excited today to have a conversation with a good friend, as well as one of Station A's advisors, Matt LeDucq, who's got a super interesting background in history in the space, from actually building, constructing these solar projects, solar DG projects, to then building out one of the biggest, if not the biggest, DG solar business at Nextera, doing over $2 billion worth of projects. So we thought that it'd be great to bring Matt into the conversation and talk about some of the implications of the latest Inflation Reduction Act, or the IRA, given his expertise and experience with DG solar, as well as some of the challenges in moving these projects forward. So with that, I can hand over to Matt to fill in any gaps on that intro. And also maybe Matt, if you could share a little bit more about what you're currently up to, that'd be great too.
Yeah, sure. So thanks. Excited to talk about it. Like you mentioned, I started off in the renewable space back in 2003 as you mentioned, an installer, actually up on the roof with a company called Powerlight that ultimately became SunPower. But spent a lot of time in the field, spent a lot of time on the project management, construction management, project engineering side of things. And I'm happy that that's where I got started, because it's given, I think, a project background as a good lens to look at investments through. As you mentioned, I went after that on and spent 7 years building Nextera's distributed generation business, where we became the largest owner of distributed assets, and put together a couple $1 billion portfolio by the time I left, which we successfully financed several times as well. And saw a lot of the pitfalls and the good stuff that comes out of distributed projects. And it's a very complicated field, but there's a lot of value for clients to extract in distributed generation. And so now what I'm up to now is I'm the CEO of Forum Mobility. Forum Mobility is a company where we are specializing in building the infrastructure needed for heavy duty trucks, specifically that go in and out of ports to make the transition from combustion engines to electric and zero emission engines. It's going to take an immense amount of infrastructure that needs to be networked together and to provide the suitable foundation for these big heavy duty trucks that move containers in and out of ports to become zero emission. And so we're focused on building that and building our company and building a lot of electric infrastructure, which will have a lot of distributed energy resources within it, and still has a lot of the look and feel of being a DG developer. And the reason why we're here to talk about the Inflation Reduction Act, what a boon, right? It's been a long time coming, and it could be something that truly unlocks distributed assets in a much different way. There's a host of complexities, which I'm sure we can talk about, that can get in the way of doing a distributed transaction. And the IRA, the Inflation Reduction Act, IRA, reduces and removes a lot of those roadblocks. So it's a pretty exciting time to be looking at DG.
Maybe to set the stage, it'd be great to talk a little bit about why traditionally have these projects been so hard to get done. We talk to a lot of buyers, and increasingly more and more buyers, and some of the biggest real estate portfolios in the world. Some of them have done a handful of projects. Some of them have done no projects, but a lot of them, the consistent theme is solar seems hard. And if you don't mind sharing, I'd love to just kind of get your thoughts and perspective on why has it been hard?
Well, let's talk real quick, why somebody does a distributed project. They do it because it beats the avoided cost. So if you're paying 10 cents for your electricity and a distributed project can come in and do it for 7 cents, well, you clip the 3 cent spread there. And that is an operating expense good guy for any company. And so that at the very core of for a solar project specifically, there's other things around storage, but really simply put, you can create some positive cash by doing a DG project. Now, how do we get there? How do you get to an ability to beat the avoided cost? Obviously, every state is different and every regulatory environment is different. So that's a complexity into itself. California is different than Illinois. Illinois is different than Massachusetts. Massachusetts is different than New Jersey, and so on. And all of those have different net metering constructs. They have different incentive constructs. And so there's some complexity in the fact that this is a state-by-state business, and it will always be. And so that's an important thing to consider, is that every state is very different. And the second thing is that, when you look at the ability to create value, an immense amount of that value is created through tax benefits. And that's specifically through an investment tax credit that's been talked about for many, many years, which is oscillated somewhere between 20 and 30%, depending at the time. But to monetize a tax benefit, you have to be a taxpayer. And as we know, a lot of companies are not taxpayers, and especially municipal entities and nonprofits are not taxpayers. So that requires you to bring in tax equity. You have to have somebody to own the income coming off the project who can then monetize the tax benefits. Introducing another party to a project is always a very, very difficult thing. That creates some friction. It creates transactional friction. It creates transactional fees, because let's just say JP Morgan or US Bank is your tax equity partner. They want to do diligence. They want to look at the power purchase agreement. They want to look at the real estate rights. They want to look at everything again. And so tax equity has always been, a positive, and tax credits have always been a positive for distributed generation. But that positive came with a complexity, and that it created a lot of friction in the transaction. And I guess and then the last thing that has made things really hard is that real estate is really, really difficult, because as Kevin, I'm sure you can attest, is that many clients have 5 or 10-year leases on buildings who want to do DG. A distributed generation project is not unlike any asset, where the longer you can amortize it, the better your monthly bill looks. A 15-year mortgage is a lot more expensive than a 30-year mortgage. And that's because of your amortization period. And so when you get into these subleases, and the way these work is that you end up with people wanting to do 8, 10, 12-year power purchase agreements to be coterminous with their lease. And that can make things really difficult. And then you kind of add the difficulty that oftentimes the landlord isn't a taxpayer, whether it be a REIT or whatnot. It just creates a lot of difficulty in the transaction to extract the value that should be there. So you end up with a market that has a lot of opportunity, but where all these concentric circles overlap, tends to be a pretty narrow group of clients.
Yeah, and I think what is like abundantly clear, there's like multiple different options, right, that a client or that a buyer can pursue. Like one is, they can purchase a project like outright, like all cash, and then they would have to figure out how to monetize that ITC, the investment tax credit. They'd have to, they would get the other benefits associated with that project, and then but maybe there's like a little bit more overhead in terms of like managing and extracting value out of that project, like getting the incentives, like operating, maintaining the system, all that good stuff. And then I guess the second path is you finance it. You do a power purchase agreement, where then a third party owns and operates that system for somebody, and it sits on their roof. Do you think that, like, of those two options, that one is more simple and less complex, like for the buyer, or does it just really depend on like who the buyer is and what their preferences are?
If you are a building owner and you have maintenance and you have folks there to maintain your building and you have this existing infrastructure there, the ability to do a direct purchase is really appealing. You're used to being an operator. You're used to doing things to your building and keeping track of the roof and the warranties and making sure that everything comes along. Whereas oftentimes there are people who are not operators, and a power purchase agreement is a great solution for those folks. A power purchase agreement does put all the risk off of you to operate something you might not know a lot about. You might not know about solar panels or inverters or these things. And the power purchase agreement is a nice way to push that risk to somebody who does know about it, and somebody who has a financial interest in it staying operating. So I think there's no right answer to it. I think there's a lot about who is doing the purchase and the resources they have and the capabilities they have that should dictate the type of transaction that they pursue.
If your grandmother had like a 1,000,000 square foot distribution center, in Illinois, would you advise her to do a PPA or all cash?
It would really depend. I would probably tell her. To do a PPA though. I have a pretty strong bias towards third party financing, just because I do know that you put the operational bucket in somebody who really cares about it operating well, and for a very long time, and is expertise in operations, and that just kind of fundamentally, from an alignment perspective, is good alignment. So I would tell grandma to probably do a PPA, unless grandma was really handy around the warehouse for some reason.
Nice. Great. So then how to kind of connect back to the IRA. So there's a lot of noise obviously about this bill. Originally called Build Back Better, now called the Inflation Reduction Act. But really the intention behind it is to spur like investment in clean energy, right? Deploy more clean energy, and is exciting because it's really the first like true federally initiated like infrastructure bill that is exclusively focused on deploying more solar, more EVs, more charging infrastructure, more energy storage, et cetera. So would love to kind of at least get your take on why it's such a big deal. And then we can kind of loop back to, how it can address at least some of these complexities we see in the market today.
Well, overall, I mean, like, who would have thunk something good came out of DC with respect to like, it kind of caught everybody by surprise, including some folks that are investors in our company who are very close to DC. It is pretty comprehensive of many things, as you mentioned. I mean, the extensions of the investment and production tax credits for wind and solar are unbelievable. The transferability of tax credits for projects that are, in certain cases, is also unlocks a lot. Direct pay is a huge deal, especially for the nonprofits who have always been kind of caught in limbo, and basically forced to mostly do a power purchase agreement. It gives them some optionality. Obviously, the hydrogen production tax credit is immense and meaningful. It has a meaningful impact on our business in terms of the charger tax credit and the heavy duty tax credit. For us, it's hundreds of basis points in our financial model of value that was created with it. So from a comprehensive and overarching piece of policy, there's nothing that's ever been better that I can think of in the history of what our federal government has put out. And I think specifically for what Station A does, like those things I mentioned are big. I mean, direct pay to nonprofits, it's awesome. I mean, it really allows a city, county, school district, municipal agency to have the latitude to purchase a system and enter into a maintenance contract if that's what they want to do. If they want to access cheap muni bond money to go out and purchase a system with 3 or 4% cash, like that's going to create a lot of value for the folks in that community, and they don't have to leave the investment tax credit on the table.
Because traditionally, like they could not do that, right? Because they would have, because they couldn't monetize necessarily that tax credit or transfer it, they would have to do a PPA as a result, right?
That's right. And now they can combine the value of a tax credit and direct pay, and so they can get that as cash, and they can access cheap capital that a lot of rated municipal agencies have access to. A lot of nonprofits actually have access to relatively effective capital, and so it's great because it gives an ability to do things that also if you are in a position where you have a shorter term lease, It allows you to own an asset that can be sold with that building or transferred in a different way. It creates a lot more options, and kind of what I was talking about at the beginning about when you look at DG and you strategize about how to run a business, you try to find all these places where all these things overlap, and then you find these little pockets of states and credit types and roof sizes and all these things where there is an ideal market for us to address and target. Now that's just a much bigger market. There's a lot more places where the Venn diagrams all overlap, and there's an ability to transact at a greater scale with a lot of different customers in a lot of different ways, and that's going to be awesome. It's going to have a really good. It's going to be, as much as this does for utility scale wind and solar, I think it's going to do more for the distributed side, because it's going to give people optionality in how they contract.
Like more people to take advantage of the incentives, that are available, right? In like a more efficient way as well.
That's right.
Yeah. That's right. So in many respects, it has like the the potential. Well, it kind of creates like an expanded market opportunity, right? So I think a lot of the estimates that I've seen say that. I mean, you look at the status quo scenario under current policy, and you look at the scenario over the next like 10 years under the IRA bill, under this new bill, and it's just an exponential difference, an exponential increase in overall investment. And I think it just instantly doubles the size of the solar market in the United States. So we talked a little bit about transferability. How is that like different from direct pay? Because it sounds, I guess in some respects, it kind of is similar, because my understanding is that like whoever owns the system would be able to transfer that tax credit to somebody else. And they could do that in exchange for cash. So it's effectively selling your tax credit, or that's kind of what it sounds like or feels like. But could you just explain a little bit like how that's different from direct pay, and also how that's different from like the status quo, and what that means for like for-profit enterprises and companies?
Well, direct pay is pretty simple, right?
Yeah.
That just comes as a check, and so but that's not eligible for everybody. Everybody's not eligible for direct pay, and so if you're eligible for direct pay, congratulations, like you kind of won. But in terms of transferability, I don't know. I mean, I've never, we've certainly traded things in our lives, right? You trade RECs, you trade LCFS credits in our life. And you typically sell those at some value. Is $1 of tax credit going to transfer for 95 cents, or is it going to be 85 cents? Is there going to be creative ways that people package these as green tax credits? I think that's all to be determined. But at its core, you're going to be able to sell that tax credit to somebody who wants it. Mm-hmm. And that's going to open up a lot, because the existing paradigm was that you brought a tax equity investor in who essentially owned in the system, for lack of a better term. Like they owned US Bank or JP Morgan, owned the DG asset on top of the Marin County Water District. And they extracted the tax benefits of it, and then that asset then flipped back to the equity owner in that asset. And so all that meant was that you had another cook in the kitchen making things complicated. And they had their own requirements, and they had their own contracts and diligence and complexities that created some friction. Now, the one thing about the transferability that is going to be a debate, and we're having this now in our company, is that tax equity still has a place, because tax equity can also eat up the depreciation value that you will not be able to transfer. So that's going to be a debate. In some larger transactions, I think that tax equity is going to be a viable option because of the value that depreciation can create in a project. But it's another option. Tax equity will still be there. Tax equity will be a construct that thrives in larger transactions for a long time. But the transferability, again, like going back to the very first thing that I said at the beginning of our discussion, is that the goal of DG is that you buy power. In the case of solar, very simply, you buy it for less than you pay for it from the load serving entity, whether it's your retailer or your utility or your CCA or whatever, whoever you're buying your power from. And DG will buy it for less. And so transferability does that. Like it opens up more ability for you to buy power for less. Depreciation, monetization allows you to take even more value. But is it worth the transactional friction and complexity that creates? Probably not on small projects. If you can get away with transferability or direct pay, like it's probably going to be a better course to take. But as you get things, bigger quantums of money will require probably a little bit more sophistication to extract all the value. But it's good. I mean, everything that came out of IRA for the business that you run is going to be a positive. It's going to be a really good next decade for DG.
I know we only have a couple more minutes here, so maybe just one last question. What advice, I guess, would you give to like a building owner or a tenant who has like an ESG goal? They want to do solar. They have an interest in doing solar on their facility. They have a goal that kind of requires them to do it. How would you, tell them, or what would you say to them to kind of get started? And how would you also respond to them, like maybe just wanting to wait and like see how the market develops? Curious to get your thoughts.
For whatever reason, people make distributed generation a very, very complicated transaction. It's not. I mean, it is very much pick a good provider, pick people who know the market, pick people who have a good reputation, pick equipment that has operational history, and start saving money. And I think that it's really pick the right people and save money. And so the waiting is always something. We've seen the market go up, we've seen it go down, we've seen supply chain shortages, we've seen tariffs, we've seen the rollback of credits, we've seen new programs introduced, we've seen those new programs reeled back in. And so, the whole free beer tomorrow concept is alive and well in DG. Like if you can save 20 or 30% on your electricity costs, like, I don't know what makes people wait, because just maybe something will happen in the future. It's to me, again, it's a really a financial decision. And maybe you want to do half your portfolio now and half of it later, or a third, depending on the size. Maybe you want to do something, but the markets ebb and flow quite a bit. I mean, there is a disaster case where the IRA can get rolled back under a new administration. So, there's a million reasons. I think that if you can work with somebody who knows the market, if you can work with a technology provider, EPC integrator that uses good equipment, go save money. Go meet your ESG goals and go do it. And I don't think that this needs to be quite as complicated as people make it. Again, I think a good advisor like Station A and other folks can help point people in the right direction of making sure that this is done in a reputable way with the right equipment, with the right folks. But to me, it's this is really you're saving money, and so if you can save a couple $100,000 a year, or tens of thousands, or millions of dollars a year, I've personally never quite understood why people are so hesitant to do it. And I also, frankly, I don't know why, for whatever reason, what solar creates is it makes people kind of go a little bit crazy, and nuts. Find a handful, 3, 4, 5 folks who really have good reputations, who have financial capabilities, whatever type of transaction you want to do. Find yourself a good advisor and do a deal. And I'll just also add, especially if your state has a program that is good. We've seen these in Illinois, we've seen these in Massachusetts, we've seen these in New York and New Jersey and other states. If your state puts out a lucrative program that saves you a lot of money, just do it. It is, those programs are finite in their horizons and capacity that they can operate. And so when people, wait to take advantage of a transitional rec in New Jersey or an SREC in Illinois, It's a little bit of stepping over a dollar for a dime.
Yeah, you're just leaving money on the table at the end of the day, right?
That's right.
And even like we see it just in a number of the projects that have come through like our marketplace just in the past year. We've seen an increase in pricing, this year relative to last year, uh, and largely driven by some of the kind of wonkiness in the supply chain. And so I don't necessarily see that changing. And we actually we see like regret, from people that they didn't move sooner, or that they wish that they didn't wait. Which is apropos because the Station A's theme for the year as a company is just don't wait. And I didn't even plant that on you.
It's just, I mean, if there's one thing, being in 20 years in renewable, like we all know, well, we can't predict the markets,
right?
Who knows? And then it's even harder to predict where policy will take things. And I think that you have those two. We've seen tariffs throw things into a bunch. We've seen tax credits expiring and then magically rematerializing. Now we see domestic content requirements that are, I'm sure, going to add a complexity over the years that we don't fully appreciate yet. And so it's one of those things, like a burn in the hand is probably not a bad thing to take advantage of, especially if you have a really good state level regulatory construct or policy to support your transaction. I agree. Like, we had no idea that IRA was coming, a month ago, and here we are. And we will have no idea that, in 2 years, maybe there is a negative change comparable to this one. So, yeah, a bird in the hand is probably a good other way of saying don't wait.
Nice. No, thanks, Matt. On a scale of 1 to 10, how much do you miss DG Solar? Last question.
I'm very excited to be in electrification. I think it's a really fun new market where we could have, and there's a lot of really good providers out there doing DG. So I think I left it in good shape.
Nice. Thanks for that non-answer answer.
Yeah, that was cultivated by like a PR consultant.
Yeah, good media training.
Let me know if you want any help on answering things.
Yeah. All right, man. Thanks a lot. Really appreciate it.
All right.